Imagine this. You've just received a mutual fund statement in your inbox. You open it with enthusiasm, ready to see how your investments are doing. But within seconds, your eyes glaze over. There it is. A grid full of numbers, percentages, abbreviations, and columns with cryptic titles like SEC yield, distribution yield, and expense ratio. It feels less like a financial tool and more like an ancient treasure map with no key. But here's the twist. This sheet isn't meant to confuse you. In fact, it's a goldmine of information that, if you know how to read it, can tell you whether your fund is truly making you money or just draining your wallet with fees. So, today, we're breaking down the mutual fund yield sheet piece by piece so you can read it without yawning, dozing off, or pretending to check later while binge-watching Netflix. First, let's tackle the big question. What is a mutual fund yield sheet? Think of it as the report card for your mutual fund's income performance. It tells you how much money the fund generates in relation to its price. This matters because, while stock investors are often chasing capital gains, buying low, selling high, mutual fund investors, especially in bond or income funds, often care just as much about the income stream they're getting. The yield sheet is where that income story is told. It will list yields in different formats, like the SEC yield, distribution yield, and sometimes trailing yields, each telling a slightly different tale. And here's where most people tune out, because the terms sound similar but have key differences that can drastically change how you interpret your returns. Let's start with the SEC yield, the one you'll often see in fund fact sheets. The SEC yield, set by the U.S. Securities and Exchange Commission, is a standardized way of calculating yield over the past 30 days, factoring in the fund's net investment income after expenses. Translation: it's like a snapshot of what the fund would yield annually if the income it made in the last month stayed consistent. This is your apples-to-apples comparison metric when looking at different funds, because every fund calculates it the same way. But here's the trick: if you're in a bond fund and interest rates are rising, the SEC yield today might be higher than what you were getting months ago. In that case, it's a forward-looking sign that new bonds in the fund are paying better interest. Conversely, if rates are falling, the SEC yield can give you a more realistic, current picture than past performance numbers. Next, there's the distribution yield, which looks at how much the fund has paid out over the past year in relation to its current price. This one can be sneaky. Let's say a fund sold some investments for a profit. It might distribute those gains to investors, making the distribution yield look higher. But that doesn't mean you're going to get that same juicy yield every year. This is why distribution yield is often called a rearview mirror metric. It tells you what happened, not necessarily what's coming. It's especially important to compare this with the SEC yield, because if the distribution yield is much higher, that could mean there were one-time gains that inflated payouts. If it's much lower, the fund may be holding back income or reinvesting more. Now, onto the column that gives everyone anxiety: expense ratio. This is where the fund tells you, in percentage terms, how much it costs to run the fund each year. And yes, it's coming directly out of your returns. A fund with a 1% expense ratio needs to earn 1% more just to break even with a fund that charges 0%. While 1% might not sound like much, over decades, it can snowball into thousands of dollars lost. So, when you look at your yield, remember, after expenses, but those expenses can still quietly erode your long-term returns. Speaking of erosion, let's not forget about load fees. These might not be on the yield sheet itself, but they can appear in fund documents and impact your returns. A front-end load means you pay a fee when buying into the fund, like a cover charge at a club. A back-end load means you pay Y when you sell, like a thanks for visiting fee. No-load funds, which skip these fees, are generally more investor-friendly. Always check if your impressive-looking yield is actually net of these costs, or if you're going to be handing over a chunk of it in fees later. Now, here's where reading a yield sheet without falling asleep requires a bit of storytelling. Imagine each yield figure as a character in a drama. The SEC yield is the reliable accountant. It tells you the present reality, standardized and consistent. The distribution yield is the historian looking back and telling you how good things were, but not always predicting the future. The expense ratio is the pickpocket quietly taking its cut while you're distracted by the other numbers. If you can see the roles each plays, suddenly the sheet becomes less of a wall of numbers and more of a financial story unfolding in front of you. Another key figure that sometimes appears is the 30-day yield versus trailing 12-month yield. The 30-day yield is a recent snapshot. The trailing yield averages the past year. Comparing them can tell you if the fund's income is rising or falling. If the 30-day yield is higher, the fund's income stream is improving. Maybe it's buying higher yield assets. If it's lower, income might be dropping. This is crucial for income-focused investors because you want to know if your payouts are likely to grow or shrink. Also, pay attention to whether the yields are taxable or tax-free. Municipal bond funds, for example, often boast tax-free yields, which can make a modest-looking yield more attractive than a higher taxable yield. The yield sheet or fact sheet should tell you this, but sometimes it's buried in the fine print. Knowing your after-tax yield is what really matters because at the end of the day, it's not about what you earn, it's about what you keep. Finally, remember that yield is just one part of the puzzle. A high yield might look attractive, but if it comes from a fund whose share price is steadily dropping, you could be losing more in capital than you're gaining in income. The yield sheet won't necessarily scream this at you. You'll need to look at total return data for that. But once you understand the yield numbers, you'll be able to connect the dots much faster and spot when something's too good to be true. So next time you open a mutual fund yield sheet, don't reach for the coffee or prepare to skim. Instead, break it down into these key parts: SEC yield for the now, distribution yield for the past, expense ratio for the cost, and compare them to see the real story. You'll be able to tell if a fund is a steady income generator, a one-hit wonder, or a slow drain on your portfolio. And the best part, you'll read it with the confidence of someone who's not just investing money, but investing smartly. And that's the power of learning to read a mutual fund yield sheet. It's not about staying awake. It's about staying ahead. If you found this breakdown helpful and you want more no-nonsense, drama-free explanations of the financial world, hit that like button, drop a comment on what fund metrics confuse you most, and subscribe for more investing guides.